Yo, what's up guys? It is Troy P here back today, and I'm excited to be talking about risk management. So again, this will be a three-part series where we go over the basics, teaching you what is a pip, what is a lot size, and then how to combine it to get a fiscal return. Then in our second session, which will be on Wednesday, we will go over how to actually combine those into MetaTrader 4 entries, and then also use a forex calculator to make sure you're risking a proper percent of your account per trade. So that'll lead into a third part where we trade live and combines last week's three-part series into this week's three-part series with a live trading. So look forward to that on Friday. So let's get into it. What is a pip? A pip is a unit of measurement that is used to calculate our returns as traders. So why do we use it? Because the ratio itself helps us gauge our returns versus other traders' returns without actually having to worry about the fiscal part of it. So if I get $5,000 off of 15 pips and you get $5,000 off a 200 pip trade, clearly there's a disconnect off of how many pips we gained, but we had the same fiscal return. So we care less in the foreign exchange market about fiscal returns, and we care more about pips. To compare what pips might look like against other kinds of traders, you could think about maybe percent gains in options. After all, PIP stands for point in percentage, so basically the same idea. You could also think about it outside of trading in general. If you are into sports betting, you can think of how many units you go up and down on the week when betting. Or if you like tacos and Nacho Libre, you can think of how many tacos is worth one pip. So clearly the difference between what one trader gains and what another trader gains is why we use pips. Let's get into actually showing you guys what a pip looks like on MetaTrader 4 or TradingView. All right guys, now that we have TradingView pulled up, let's get into what is a pip. So a pip is a lot smaller than what a lot of people think looks like in the foreign exchange market. And just in the past 1 5-minute candlestick, we've seen this candle already move 0.6 pips with a whole 3 minutes left. So this is what a 1 pip movement looks like from 0.85512 to 0.85502. So you might see that decimal place right off the bat that indicates that 1 pip movement. So this is what a 10 pip movement would look like. From 0.85512 to 0.855 or 85412 is going to be that 10 pip movement. So that's important for us because we are starting to show you guys where the decimal place changes when you have a certain amount of pips. So right here, that's the ones place, think of. And this is the tens place and the hundreds and thousands. So what you can actually use to better help you calculate this is to take the number, because they're always gonna look pretty similar, and just subtract it. So 85,512 minus 85,412, you're gonna get 100. If you divide that by 10, then you're going to have the pip return that you are correctly identifying in the market. So let's go on to a little bit more of a tricky example here. Say we want to figure out the difference between 85609 and 8601. And we see that is a 40 pip movement. And I said 0.8601 on the dot, so you guys can see that visually. It's a 40.1 movement. And how you can more easily identify this is by taking 86,010 minus 85,609. You're gonna get that 401 that you then divide by 10, and then you'll get your 40.1 pip movement. So that's extremely important for you guys to understand, is how to calculate pips. It's always the first thing that I teach someone coming into the foreign exchange market, is how do I tell the amount of pips per trade gained or lost. Another feature that I want to show you guys on TradingView, and the reason this video is being made on TradingView, is because you can then use TradingView as a tool to help you better calculate it. So this is your stop loss, and yours will look something more like a red, and then a green, mine is black and tan. And you can see right here is where the pip counts are being given to you. So this is a 5.9 pip movement, and this is an 8.9 pip take profit level. So that's how that works. And then it doesn't really mean anything until you start to combine it with actual lot sizing. So the reason lot sizes are so important in the foreign exchange market is because they derive the actual fiscal returns that you're going to receive and see in your account. So say I have that 5.9 pip stop loss, and I have that 8.9 pip take profit. If you and I took the same exact trade, I could gain, like I said, $100,000 on a trade, while you only get maybe say 10 to 20 bucks out of it. So it doesn't matter until you bring in lot sizing. All right, guys, let's take a little trip back to high school math here. So today we're going to be learning about equations. The equation we have in front of us is pips plus lot sizes equals fiscal returns. So what that means more in depth is that if you are trying to figure out what the fiscal returns are, and when I say fiscal returns, I mean that little bar in MetaTrader 4 that you can read at the top that says plus or minus, it's either gonna be red or blue, that's what I mean when I say fiscal returns. If you're trying to figure that out, the equation to do so is lot size times pips. If you multiply one lot, which is 10 cents per pip, times 20 pips, you're gonna get $2. That's going to be your fiscal return. So hopefully it's starting to make a little bit more sense of what I'm getting at here, guys, is that if you want to know exactly ahead of time what your stop loss is and what your take profit is in terms of fiscal values, you're going to need to multiply your pip worth and your amount of pips. So 10 cents per pip would be 0.01 lot, 20 pips, $2 return. If your stop loss is half of that, you're going to have a $1 return. So hopefully it's making a little bit more sense now, guys. Just to make sure you guys are really getting it, and before we wrap up, we're going to walk through a live trade. All right, guys, we're gonna take EG short and pretend like this is a trade that we would actually take. I've done no prior analysis to this session. Want to just make sure you guys know that if you come in and watch this video tonight, the trade doesn't play out. Wanted to make sure you guys know this is not a live trade. This is not a live trading session, but we are going to take EG short. So right now, price is currently at 0.85505. So we're going to set up our take profit levels and stop loss in this trade. And to do so, you're going to want to make sure you come out to a more reasonable time frame. So for this trade, I'm going to say that since price just today was at this point down here at New York's open, it would be reasonable to believe that it could get back there. So that would leave us with around a 25 pip take profit. We're going to keep ours right at 25.5. And then again, since it was just up here today, we're going to believe that that's a reasonable place for this stop loss to get to. Then we're going to add a little bit on top just to make sure that we don't get stopped out where price hasn't reached before. So this tool is super cool in TradingView, and the reason that we're actually making this video on TradingView is, again, to make sure that you can see visually and understand the pip counts. So 25.5 pip take profit, 10.5 pip stop loss, with a risk reward ratio of 2.43. So we'll go over risk reward ratio again in the future, but not something we're covering in this 3-part series. So you can already see right off the bat that this take profit is much larger than a stop loss. That's what a risk reward ratio is, something you're always gonna wanna make sure happens with your trades. And if we were to see this trade play out negatively and we stop out right there at our 10.5 pip stop loss, with a full lot, we're gonna have just lost $105. And you might be asking, how did you calculate that so quickly? The reason is that because a lot of the pips and lot sizes that you're gonna be using are clean numbers. So I have a 10.5 pip stop loss and a full lot is 10 pips per dollar. So you do the math, $105 for your stop loss. And if we're using that same 25.5 pip take profit with our full lot, then we're gonna have a $255 reward. So you can see now why it's important to calculate this ahead of time, because if you're just entering this blindly with a full lot, more times than not, you're gonna lose that $105 and then not even know what you would have gained had you hit your take profit. And if you're using multiple take profits, it's extremely important that you use this at each take profit to know how much you will be returning. That, guys, is how you put them together. And tomorrow we will be going over how to use the FX calculator to help maintain your stop loss and account size. So hopefully this video was helpful, guys. If you have any questions, comment them below. Make sure you like and subscribe. If you need anything, I'm Troy P. Make sure to join the EliteSignals Discord, and I will see you guys tomorrow.